And we are back. Welcome back. Today what I want to do is build off of the previous video where I discussed how to make and lose money trading. In the previous video, I quantified this idea of trading eggs, which you may have heard before floating around the trading space, by using the law of total expectation. Essentially what I do is I quantify a trading strategy and I derive the expected value of that trading strategy on a per trade basis by taking a look at the probability of winning, the probability of losing, the average P&L for a winner, the average P&L for a loser, and if that is overall positive, then we say we have a positive edge or a profitable trading strategy. This is clearly a non-trivial task. This is what traders all around the world try to do on a daily basis. But what I wanted to really emphasize today was the idea of when to stop trading what would otherwise have been a profitable trading strategy. And this could be for a variety of reasons. There could be a regime change, maybe the macro conditions have changed, maybe people have caught on to this and there's less capacity to trade this type of strategy. I'm really talking about systematic trading strategies, statistical trading strategies, a large cross-section of equities, and you're doing some sort of condition to buy and sell on a daily basis based on some sort of signal that you've developed. And the idea that I'm trying to emphasize here is the parameters that we estimate for our trading edge are themselves governed by some sort of unknown density. And that density has the propensity to be non-stationary. So the problem is we can't continuously get a good estimate for the probability of a winner, the probability of a loser. In fact, when we start to lose more than we win, we may never see the conditions for success in that system again. This will become more clear when we start to look at the charts, but let's go ahead and break down this idea of egg really quickly right here, and then we're going to take a look at some charts and hopefully hammer this idea home. So we have edge defined as the probability of a winning trade times the P&L of the average win less the probability of a losing trade times the average P&L of a losing trade. Of course, if this is positive, you'll make money over time. If this is negative, you'll lose money over time. The problem is, in the context of parameter estimation, we don't necessarily know we absolutely don't know the density in which these originate from, and that density, as I said, has the propensity to change over time. That's this idea of non-stationarity. So it's definitely a difficult problem. It's not impossible to deal with, otherwise people wouldn't trade. Now, whether or not the trading practices are questionable and people are citing statistics incorrectly is a whole nother ball game, a whole nother issue. But here, what I want to do is I want to highlight this idea of parameter estimation in the context of a stochastic function, or a time-dependent function of a stochastic process. That is this edge right here. So what I have here is the probability of a win being 0.55. The average winner is 10, the average loser is 8. Clearly, this is going to develop some sort of positive edge, and this is what our equity curve would look like if we were to trade this particular strategy over, 1,000 trades or so. Now, this is, of course, stochastic, so if I reran this, I would get a different equity curve, but notice, on average, we're accumulating P&L. I believe I random seed it here. Yeah, so I random seed it here, so let me get rid of the seed. But due to the positive edge, even though this curve looks a little bit different every time we run it, we still see that up and to the right behavior. And that's exactly what we would want to see. We don't want to see, very choppy activity. We don't want to see large drawdowns. We want to see a very nice, smooth equity curve. In fact, the smoother that it gets, the less supposed or the less risk we have in deploying this type of strategy. Now, this does not necessarily mean that this is going to hold up in the next 1,000 trades, and that's what I'm about to get to here. Now, of course, the actual P&L is arbitrary, right? you can just, it's linear, you can just add leverage and you can multiply this entire curve by 4 to increase the profit. So we're not talking about any form of optimal risk reward here. There's no Sharpe, there's no Sortino, we're not looking at ratios, we're not looking at the performance metrics associated with the strategy per se. We're just analyzing it from a statistical point of view. Whether or not this is a good equity curve is depends on a lot of different things. It depends on the macro environment, the current risk-free rates. It depends, what did the S&P return, what did all these other things. So we're not going to talk about the performance metrics of this strategy, but like I said, we're going to analyze the statistics. So clearly there's a positive edge here. If I reran this, I would continue to get different equity curves. Trading the strategy is productive, it would appear. Okay. Now the parameters are 0.55. The average winner is 10. The average loser is -8. If you use a limit, so let's say you have a limit stop for taking profit and for a stop loss, then these could be fixed values. And really, you would just be looking at the probability of wins and losses over time, which does simplify the space quite a bit, but you're still going to deal with these same issues. So just keep that in mind. Even if you don't have some sort of trailing stop and your take profit is going to be scaled by however much of a run it goes up, you're still going to face this issue. So the average winner, average loser could be simplified to fixed values, but nevertheless, we still have this probability of winning and losing we have to deal with. So what do I mean by the probability of winning and losing being non-stationary, changing over time? Well, probability of winning and losing, and perhaps even the average win and average loss, depending on how you enter and exit trades, can change. So what I mean by this is here I'm going to add some sort of decay to the win rate. So as you can see with this particular equity curve, the edge decays over time. Now this could be due to a variety of things, as I had mentioned earlier. It could be the macro environment is completely different. It could be rates being higher, rates being lower. It could be due to regulatory issues. It could be due to this or that or whatever. That's kind of the job of the trader to figure out what is going on with their strategy. But here you can see this is not the up and to the right behavior that we were looking for prior. So if we look at the previous equity curve, we see this growth all the way to the 1,000th trade. But when we look at the 1,000th trade here, it starts to plateau. And this is what I've seen in quite a few systematic strategies. I've seen sentiment-based strategies. They work really, really well. And then 2021, 2022 hits and it starts to plateau. And, the key question is why? Why would that be the case? And that's when you go to your quant researchers and you say, fix this. And your quant researchers go, well, it's not that easy. The entire regime for sentiment-based strategies has changed because of this, because of that. Maybe different type of sentiment signals work better in this new regime. Maybe they don't work at all. But you can quantify what's going on prior to understanding why very easily by just taking a look at your trading profitability over time in this context. So here, what we have is we start with 0.55, and I have a linear decay. So I'm going 0.55 to 0.4 over the 1,000 trades. So you can see my profitability goes from 55% wins, so that's the probability of winning, to 40%. And the average winner is not big enough to outweigh the decrease in probability. Thus, we start to plateau here. We don't get that up and to the right behavior. Okay, so what we're looking at here is the change in the probability of winning or losing a trade over time. We don't know the dynamics of that specific probability. If we did, it would serve us quite well and there would be no need to develop any sort of model for it. So what could the dynamics of that process, that parameter process, look like, if you will? Well, it could be mean reverting, there could be a drift or trend, or there could be a regime shift, and there could be jumps and shifts in parameters all about the process's space. So what could this look like? Well, this is the linear decay that I had just displayed in the previous equity curve that had plateaued, here I have the probability of winning on the left y-axis here, and the equity value on the right axis here, the right y-axis. Now the parameter starts at 0.55, and this is just a linear decay. This is quite unlikely as to what the actual dynamics of the probability of your winning or losing a particular trade in a strategy set would be, but it's quite a trivial example to see what's going on. So what you can see here is we start at 0.55, and after each trade, we're doing pretty well. And then the parameter continues to degrade until it gets to 0.4, and now we're seeing some plateau in the equity curve itself. We're still winning. We still have our average winners to be greater than the average loser. Otherwise, we would begin to lose equity value here. But this is hopefully a very interesting diagram to see what could be going on in your trading strategy. You can see the probability of your win. The probability of winning in your trading strategy is decreasing over time, and the probability of losing is just the complement, 1 minus the probability of a win, and that's increasing over time. So this is very informative as to what's going on here, and this is nothing that you can't do yourself. If you had an Excel sheet of your trades and your equity over time, then you could develop this plot on a cumulative basis. You would just accumulate the probability over time and see what happens to this probability of winning and the corresponding probability of losing. Now, clearly, it's not going to tell the entire story, but if you see your equity curve increasing, and then plateauing or decreasing, then you can take a look at the probability of winning, probability of losing. Maybe that doesn't change. Maybe it's still 60-40 and you're winning a good fraction of the time, but maybe your winners are now smaller than your losers, and your losers are too big, and that's what's dragging your equity curve down. So you can do this sort of analysis to see kind of like which lever you need to pull to hopefully get your strategy back in order. You could see, oh well, my winners are still winning, so I have a good probability of win, probability of loss, but my average winner is decreasing, because that's a whole nother dynamic that we're not even looking at. You could plot that as well on a different y-axis. But these two that we're looking at here, the probability of win, probability of loss, you can swap that with average P&L, because if you're not using fixed stop, loss, and profit takes, then that itself too could also be, again, based on your entry and exit conditions, could be a stochastic process as well. So here we're taking a look at the probability of win, probability of loss over time. This is just a linear decay in performance. If we scroll on down here, we're taking a look at a completely different possible process to explain the dynamics of the probability of winning, probability of losing. So here, what I have is I actually have a mean reverting process. And what I'm trying to show you here is we don't know the density, the underlying dynamics of the change in probability over time. If we did, then we would know to continue to trade our strategy or to not trade our strategy. But we're going to try to model it, and by modeling it, we can graph this using live trading data. But what I'm doing here is I'm simulating possible dynamics. So previously I showed you this is just a linear decay in probability. Here, this is a mean reverting process, the probability of winning, probability of losing. Now, what you can see is the probability of winning kind of has this negative drift, but then it gets drawn back to a mean value of 0.51. So there is still that edge, but it changes over time. Now, we're still up and to the right here, but not nearly as much as when we had our fixed edge in the beginning, right here. We go from 0 to 1750, of course that's random, but we come down here and we are 0 to 800, and this is going to have a completely different Sharpe ratio if you want to talk about performance metrics. 0 to roughly 800, and this is going to have a completely different Sharpe ratio compared to the previous equity curve. Of course, it's going to be much worse because we're simulating the true dynamics of this probability of win, probability of loss. You could fit like an Ornstein-Uhlenbach process, the mean-reverting process, to your data and simulate it forward to see what it could look like. But again, there really is no cut and dry answer as to what you should do. Now here, what I'm trying to show you is this could be the case. You could have a profitable strategy, and over time that probability of winning is going to be mean reverting, and it's going to come back up maybe to maintain that positive edge and the profitability of your strategy. That's one instance. You could have linear decay or somewhat linear decay. Very unlikely it's going to be as straight line as this, but more likely it'll have some sort of negative drift, if there is any at all. So here what you can see is the probability of winning has this negative drift, and it starts at like 0.6 and then it starts to come down, and again it's just a stochastic process, so it's gonna continue down, and then maybe it stabilizes, maybe it has some mean reverting tendencies, maybe it has some jumps, who knows. But these are the possible dynamics of the change in the probability of your wins and your losses in your trading strategy. Okay, so what can you do to combat this? Well, there's a lot of different things you can do. The simplest thing to start with, if you have been trading for a while and you're trading the same strategy, maybe this is systematic, maybe you have a specific type of day trading strategy that you use, however you choose to trade, what you can do is you can just plot your equity curve over time, and you can plot your wins and losses, your cumulative probability of wins and losses over time, and you can see how they evolve throughout time. You can see, oh well, my probability of winning was significantly larger here, the probability of losing was significantly larger here, and you can kind of check out the dynamics of what your strategies, P&L and probability of win and loss looks like. If it looks something like this, it may be time to retire the strategy. This is a good indication, something like this, that unless there is a drastic change in the probability of winning, which is reasonable to even monitor over time, so don't actually trade this strategy. I would never trade this strategy if the probability of winning was degrading like this and the probability of losing was increasing, and we assume some sort of fixed average win, average loser for our P&L. I would never trade something like this, and you shouldn't either. But what is reasonable to do is to track this over time and to see, hey, like now it's starting to win again, right? If this blue line starts to revert heavily back to the mean of a positive edge, then it might be reasonable to trade this strategy again. Okay. You may choose to use moving averages, you may choose to use, a lot of different things to quantify a window, perhaps, of the probability of winning, probability of losing, but we're not going to kind of dive into that into this video. It kind of opens a whole separate can of worms of TSA, and I'm not really interested in diving into that in the remainder of this video here. This is another good example here. If, you have some sort of mean reverting-esque process like this, then here this is even kind of a toss-up. Should we trade this strategy? Well, we went from 0.51 all the way down to 0.42, and we plateaued pretty aggressively. In all reality, with transaction costs, we probably would have lost money here, and then we started to come back up here to 0.51, 0.52-ish, and even this is not enough to trade. This has a negative drift. Even though it's mean reverting, this would not be reasonable to trade. Now, it could eventually have a positive drift, and the probability of winning may even be greater than 50%. Then it might be reasonable to begin trading again. So this is what I'm trying to say, is when should you stop trading a profitable strategy? Well, when it stops becoming profitable is an acceptable answer. But more quantitatively, it's like, well, you can look at your edge and you can see the degradation in your performance over time based on your actual trading data or simulation with fitted parameters if you want to assume some sort of model and dynamics for your parameters. So I hope this video was helpful. I hope this video was interesting in explaining how and when to stop trading a profitable strategy. Again, really what we're looking at is we're just looking at this idea of edge over time. This is just one way to determine whether or not you should trade a strategy, right? If we have negative EV, we probably shouldn't trade it. If we have positive EV, then I think it's reasonable to trade. But, that is something that you're going to have to determine for yourself based on your own strategies. So I hope this was an enjoyable video. I hope these charts were interesting and helped explain the idea visually of what edge is as we're looking at it with respect to a strategy's win and lose rate and the equity that we are generating by trading that strategy. If you have any questions, please feel free to leave them in the comments below. If you want to ask me a question directly, I tend to be more responsive on Discord. That'll be in the description below as well. Other than that, thank you so much for watching, and I will see you in the next video.